Time versus timing. Timing is everything. You've probably heard that phrase being used a lot, right? Well, it's true in most cases, but not all. When it comes to successful investing, it's really more about time and less about timing.
Confused? There's a difference. Timing is the act of entering and exiting an investment at specific moments and hoping that these actions will give you good investment returns. Time? That's very different. Time is the amount of time an investor gives his investment to generate the desired rate of return.
Okay, suppose a friend and you have to travel from Kanyakumari to Jammu. Both of you get on the same train at Kanyakumari. Now your train has quite a few stops, but you are clear that you will not be changing the train and will continue the journey till the train reaches Jammu. But your restless friend has other plans. He thinks there are faster ways to get to Jammu and he doesn't like waiting at layovers. So what does he do? At the first station, where the train stops, he gets down and changes the train in the hope that it will get there faster than the first. He does that repeatedly, changing trains at every station. But he does not realize that every connecting train may not be available at the same time he has left the previous one. And every time he gets off, he increases his risk of not being able to catch another train on time. Also, some trains may take a longer route than he realizes, and his cost of traveling goes up with each new ticket. So while you're comfortably sitting in your seat enjoying the view outside your window, he's constantly under stress trying to figure out the earliest next train to catch. Now compare your friend to a hyper-investor who just cannot invest regularly and in a disciplined way for a long time. He believes in timing, hoping to get in and out at the right moment. He observes the stock market, reads newspapers, speaks to brokers, and watches business channels, convinced that all of this will help him make the right investment decisions and earn handsome returns shortly. Basically, he wants to work with timing or appropriate time, buying when he thinks the market will go up and selling when he thinks it's at its peak.
The idea of buying at a low and selling at a high does seem logical. But where's the certainty in this? In market timing, that's two decisions that an investor has to get right. The right time to buy and the right time to sell. Seems like a risky investment strategy, and getting those right days to buy and sell is like trying to predict the weather precisely.
Back to the train journey. You, on the other hand, have a relatively stress-free time. You're comfortable on the train and you don't want to deal with the hassle of getting on and off because you're already on your way to your destination. Similarly, in the investing context, say you wanted to invest in an equity scheme for your 10-year-old daughter's higher education. You've estimated that you will need rupees 20 lakhs after 10 years, and to get you there, your investment advisor has advised a monthly investment in an equity fund that is likely to deliver an average return of 12% per annum over the estimated period. Well, you simply need to invest approximately rupees 8,694 every month to reach your investment goal. Slow and steady will most likely win the race.
Playing the market based on timing strategy can cause sleepless nights because it's a tough process to keep up with consistently over a long period of time, and the potential for huge losses at any stage is enough to rattle anyone. But just being calm and consistent during your journey can still get you to your destination. Long-term goals like retirement planning, children's marriage, buying a house, etc. could be achieved with a strong financial plan, a clear time horizon, and long-term investing. Let's go over these points again. Market timing is definitely more risky and could cost an investor's investments dearly. Transaction costs also tend to be higher, and it can be counterproductive by playing with an investor's emotions, making them panic when the market swings down and making them greedy when it's moving up. This could, in the long run, unsettle a person from his goals. A better option for anyone is time spent in the market. Look at the long run and accept the fact that market movements are very hard to predict accurately. And focus on the end goals instead of the noise in the market by giving investments time.
You see, there's a big difference between time and timing, and when it comes to investing, steady is the way to go. So why wait? Now's the time. We hope you enjoyed watching this video. Watch more and we'll help you learn about different investing concepts. You can also write to us with your feedback at editor@templeton.com.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.